Hello and welcome to the monthly Roundup from Kepler Trust Intelligence, brought to you in association with Schroders. Join me, Ryan and David as we discuss the most interesting news and hot topics for investors from the last month.
And coming up on this month's podcast, David runs the rule over the Greencoat results, as well as finding out where personal assets has been in finding opportunities this year, before discussing the trusts and stocks that retail investors were buying in August.
Jo will run through the highlights from the recent Market Matters podcast on the biotech sector, as well as her chat with Richard Sennett from SOI about investing in Asia. But on a different topic, we're going to take a quick look at the best ISA providers on offer for investors in the UK today.
But first, Ryan will be discussing the news with some updates on recent corporate activity. He's also going to look at the implications of some manager changes, as well as giving our take on some positive news for Scottish Mortgage. So Ryan, that's quite a long list. Where do you want to start?
Absolutely is, and I think we will kick off with an update on the Gore Street situation. Now, we discussed this last time, but as a quick recap for those who are not regular listeners, RM Funds took a stake in GSF, Gore Street, and used this to try and overhaul the trust and the strategy. Now, this included a proposal to replace some of the directors and drive improvements in the approach. Now, since we last recorded, the vote has been held, and whilst RM technically lost their proposals, the scale of the dissent, with around 30% of the vote casts from turnout of around 62% of shareholders, voted against the current board and with the proposals made by RM.
So that's a decent size voting against, but flipping this argument around, it does mean that over 2/3 of those that actually voted, which makes up around 40% of all shareholders, voted for the status quo.
Yep, that is very true. But with RM only owning sort of 6% of the shares themselves, it shows that there are a sizable number of other shareholders that are unhappy with the board and the investment strategy. Now, to try and quell this dissent, the chair has announced plans for a new director imminently, with another one to come later down the line. This has also come alongside a tweak to the strategy, with a plan to sell some of the sort of riskier assets, those that are still in construction, and focus the trust more into the areas with immediate cash generation. This all has the goals of improving the operational performance and the sort of fundamental numbers of the trust, and therefore help support narrow the discount.
And what's the takeaway from this?
Well, whilst not the sort of full overhaul that RM were hoping for, the whole episode has been sort of a bit of a shot across the bows for the trust, and should sharpen the minds of the board to focus on nearer term returns and improving operational efficiency, which in theory should lead to better sort of NAV returns and therefore better shareholder performance in the near term, should that plan come to fruition.
And sticking with updates for a little longer, what was the resolution of the Warehouse REIT situation?
Yeah, so we mentioned that Warehouse REIT was the subject of a bit of a bidding war back in July, and this looked to be coming towards a really interesting outcome, with an auction process between two bidders.
That sounds quite unusual for investment trusts, but not so much property more generally. What makes this so interesting?
Well, lots of M&A activity is usually done behind closed doors in negotiations, with sort of only final commitments made to the market. So by having an auction, it would have given us quite a bit of clarity on what these two investors thought was a full valuation, i.e. what their maximum value was for paying for it. And that would have had really interesting ramifications across the whole investment trust industry.
So that sounds really interesting. Do we have an outcome yet?
We do, though, unfortunately, for those of us who are looking forward to having some price transparency, the auction was called off at the 11th hour as one of the bidding parties, the private equity firm Blackstone, increased its bid, something which Tritax Big Box was unwilling to meet. As such, Blackstone has now won out, the shares have been delisted, which means that sort of investors of Warehouse have cashed out, taken a short-term profit, and another investment trust is lost, which is a bit of a shame, particularly when the outcome could have been so interesting, although it does at least show that if shareholders aren't willing to recognise the value, other investors will.
Yeah, that's very true, although you do wonder at what cost. Now, next up, we have a manager departure. Ryan, would you care to elaborate on this a little?
Of course, yeah, August saw the departure of the Pacific Assets co-manager David Gates. He, along with a couple of other managers at the wider Stewart Investors firm, left the business together after a multi-decade stint.
Do we know where they're going yet?
Well, nothing's been announced of yet, and we don't know the reasons behind their departure, so we won't speculate on that. One thing we can say is that David had already handed over lead management duties of the investment trust that he ran, Pacific Assets, to co-manager Doug Ledingham in July 2025, and that was part of a long-term succession plan. As such, we don't believe that this manager change really affects the long-term management of the trust, which, it must be said, has a very disciplined and long-standing process, although the loss of David's experience will be a bit of a pity, as he's been a pioneer of this type of investing in the region.
Thanks, Ryan. And finally, we have some news from the ever-popular Scottish mortgage.
We do indeed. We have a quick hit from SMT, which saw the benefit of a NAV uplift as one of its private holdings, Databricks, had a valuation uplift of 60%.
And that's quite the jump. So how has that transpired?
Well, crucially, Databricks is a private company, and therefore it will have periodic revaluations based on very specific events. Now, in this case, it was a new funding round, which saw the analytics firm jump from a $62 billion valuation to a $100 billion valuation, and that added around 40 basis points of NAV performance for SMT. Now, whilst this pickup in performance is a positive, it's worth noting that this is only a result of a small investment into the firm, which has led to a big value uplift. So it's more of a sort of contributing data point and could arguably vary going forward, but such is the case of private equity valuations. Conversely, one could argue that it means that the prospects of an IPO for the firm has been pushed back a bit, as they seem content on raising private capital a little bit longer. However, as it is another indication that there is appetite for the right private companies amongst investors, and perhaps NAV valuations across the board in many cases are more accurate than that people are willing to give them credit for. And if this is the case, then some of the wide discounts we can see across the industry could be sort of somewhat questionable, or for some, an opportunity.
And do you think that might include Scottish mortgage?
Yeah, absolutely could include Scottish mortgage, which at time of recording has a discount of around 9%. So that is showing that investors are not really valuing those private equities at NAV. It's worth noting that Databricks itself was a holding for stablemates Schahalian and Baillie Gifford USA, as well as an indirect holding for REIT Capital. So there are numerous trusts also with private exposure that could benefit from this NAV uplift. Now, many of these are also standing at a discount, and we think the ability to not only hold these private assets, but also stand at discounts is a good differentiator for the investment trust sector. And these trusts have really demonstrated their worth and been able to benefit their shareholders with this improvement. Now, moving on from the news, David, you were fortunate enough to be on the results roulette in August and only had just one to cover. So what updates do you have to share with us?
Yeah, so a fairly kind of quiet month on the results front, but we had a half-year update from Greencoat UK Wind, or UKW. Overall, I'd say the results were a bit mixed. I guess the big good news here was that it's already announced 10.35p per share. Dividend was covered 1.4 times. Now, it should be noted as well that that is an increase from 10p, so 35%, which is a big one. It has a yield of 8.7%. Again, a decent yield there. There was also a continuation of their share buyback program. On the other hand, we did see lower than budgeted wind generation, which saw a fall in NAV. That's obviously kind of out with the manager's control, though.
Yeah, so decent income generation despite that poor wind generation, and dividend was still covered. And there are more positives in there, right?
Yeah, that's right. Now, one thing that should be pointed out is that, for all these trusts that invest in illiquid assets, such as property, infrastructure, or indeed wind farms, where these are kind of, they've not got live pricing, they're priced once every month or 3 months. There's always an element of estimation when those net asset values are calculated. Now, the real proof of that NAV is in the pudding, and the pudding is kind of when we see actual deals happening, because when they actually happen, you can kind of compare the theoretical valuations in the NAV with the actual sale price. Now, the good news for UK Wind and its shareholders were that the trust partially disposed of 3 assets, all of which were sold at NAV. And to us, these sales show that private asset buyers agree with the valuations UK Wind has put on its assets. And if that's the case for all of the portfolio, then the 18% discount seems very much overdone. Now, moving on to podcasts, Joe, we welcomed Elsa Craig from International Biotech Trust to talk about all things biotech. What stood out for you?
Yeah, as always, this is just a taster. So I'd highly recommend heading over to YouTube, Spotify, or Apple Podcasts to listen to my full conversation with Elsa. I think one of the big themes we touched on were GLPs. They're a hot topic at dinner parties across the land, I gather. And they're already mainstream, as we know, in treating cardiovascular disease and obesity. But Elsa also highlighted Novo Nordisk's EVOKE trial, which is looking at whether GLP-1s can also slow the progression of Alzheimer's. Now, the readout is due this month, and if positive, that could be another really exciting breakthrough, both in terms of quality of life and also the GLP-1 market more broadly.
And what were Elsa's thoughts on the kind of broader recovery for the biotech sector, particularly amid all the tariff turbulence that we've seen?
Yeah, good question. I think all three of us have biotech exposure in our personal portfolios, so this topic is certainly close to home for us. The good news is the MBI is up around almost 30% or so since it rather tanked in early April, although that's only really returned us to where we were before that. Elsa definitely sees pent-up value in the sector, but she does think that investors will probably continue to hang back until there's more clarity on tariffs and drug pricing, and this is still one of Trump's many pet peeves. She's upbeat on earlier stage but de-risk names, also on rare diseases, which she sees as less crowded than oncology. They're quicker and cheaper to market, and there's a huge unmet medical need there. So I think plenty of reasons for optimism for biotech investors, but patience is probably still likely to be required for the near term at least. Now, David, you spoke with Charlotte Yonge from Troy Asset Management for another Market Matters podcast. What did she have to say?
Yeah, so Charlotte co-manages a personal assets trust, and it's always interesting to me, at least, to hear what the managers of these kind of capital preservation trusts have been doing and what they think about markets today. Because, you know, like I say, they're all about kind of capital preservation and are never going to be kind of heavy on equities. So it's always good to get that kind of that view. Having said that, Charlotte did note that P&L had increased its equity exposure in April amid the tariff ructions, which is obviously a good move in hindsight. The trust does have most of its equity exposure in the US, so yeah, it looks like a good move so far. Having said that, P&L does have a relatively low weighting to equities, around 40%. And Charlotte thinks that, particularly at the moment, you know, after we've seen this rally, that other areas could look attractive, and those include short-dated government bonds and gold, despite having taken some profits from the precious metal.
And Charlotte also does some work with a charity that very neatly ties into the theme of the Market Matters podcast. What was that?
Yeah, so Charlotte is a co-founder of Girls Are Investors, which, you know, you might kind of guess from the name, is a charity that kind of aims to educate and inspire young females about a career in finance. And I'm sure we're all well aware of the fact that the investment industry is quite heavily male dominated. So it's certainly a worthwhile endeavour. And you can find more information about it in the description of the podcast that we did with Charlotte. And I would say that it is a really worthwhile podcast to listen to.
Absolutely. Thank you, David. Now, Joe, moving on, it was Richard Sennett's turn to sit in the hot seat for an Asian-themed episode of Trust Issues. Could you give us a couple of highlights, please?
Yeah, sure. Probably worth saying up front that SOI is a really interesting fund because it's got that dual income and growth mandate. But actually, if you look at 5-year share price returns, it's actually beaten its growth-focused Asia-Pacific peers by a fair margin. So that's really quite impressive for that dual mandate. Now, we've seen Asia's dividend culture really start to bed in the last few years, and it's starting to challenge the traditional equity income markets, for example, in the UK and Europe. But SOI very much shows it's not about stuffing the portfolio with the highest yielders, and you don't have to sacrifice growth to generate an income.
And what area of the market is Richard most excited by?
Yeah, the fund's long been overweight technology, especially TSMC, which is to Taiwan what Nvidia is to the US. However, Richard has been trimming positions a little. He feels that AI enthusiasm has started to stretch valuations. Elsewhere, he likes Singapore's growing importance as a financial hub, also Hong Kong as a proxy for China. And there's also some domestic flavour through financials, through real estate, and also consumer staples, which are all supported by quite a solid economic backdrop. So all in all, I think it's fair to say the trust offers a fairly diversified mix of some attractive structural growth drivers across the region. Now moving on to one of our regular monthly blogs. David, what were investors buying in August?
Yes, I think we're kind of quite used to there being not much change here, really,
Yeah.
which is probably a good thing, actually. I guess, you should be doing that pound cost averaging, buying the same thing every month. But yeah, it was a similar story, particularly in the trust world. Scottish Mortgage, JP Morgan, Global Growth and Income, City of London, Temple Bar, the big hitters all high on the list. Polar Capital Technology kept its place in the top 5. It came in July, so it's been in there for 2 months now. And Allianz Technology would have been in the top 10 had we done that instead of a top 5, which is really interesting coming during a month where we saw some research from the prestigious Massachusetts Institute of Tech, better known as MIT, which found out that despite all the kind of artificial intelligence hype that we've seen, actually 95% of organizations are getting zero return from their generative AI investments.
Right, that's quite a concerning stat, possibly. Did that make an impact on our most bought shares list then?
It didn't make a huge impact on our list or markets on generally, actually. We saw some kind of slight turbulence. I'm not sure. I think turbulence is a bit of a heavy word for it, but markets have kind of continued to hit record highs. We even saw Oracle, which does kind of cloud computing and database software, saw 35% in the space of just one trading day. Which suggests maybe that the AI-fueled run will likely continue for some time, especially with US interest rate cuts imminent. So Nvidia and Palantir were both still high up on the list, and investors certainly look to be kind of trying to ride that wave as high and as long as they possibly can. Another rise that investors are keen on riding is the gold boom, though not in the traditional sense of buying gold ETFs, but aiming for quicker and larger gains through the miners. Metals One has been on the list a few times, but we did have a new name, which is Wishbone Gold, and you can probably hazard a guess as to what they mine.
Yeah, I think we can work that one out. Now, Joe, you've also been running the rule over the best stocks and shares ISA providers. Do you want to talk through your findings on that?
Absolutely, yeah. It's worth saying upfront, it's not a one-size-fits-all job. It's very much tailored to what an individual investor is looking for, but we focused on 3 main criteria, which were fees, choice of investments, and those all-important Trustpilot ratings. I think, being honest, probably most of us are a little bit blasé about fees, but they can actually really eat into your returns. Now, if we start off by looking at trading fees really quickly, some platforms don't charge trading fees, some charge up to £12 a trade. So that's okay if you're a buy and hold long-term Warren Buffett type investor. But if you fancy yourself as a little bit of a Wolf of Wall Street type trader, you are going to be racking up some quite serious trading fees on that front. And it's a similar story for platform fees, really. They're the annual charge for holding your ISA, and these range from 0 to 0.5% to a flat monthly fee. So definitely worth making sure you know what fees you're paying in terms of your ISA provider. And we've also done a handy calculation for this view across the main providers. Now, in the interest of editorial integrity, I probably better not reveal my chosen provider, but I'll put you both on the spot instead. So can you both give us a little bit of a heads up on why you chose your ISA providers? Perhaps David, with you first.
Yeah, so it was actually a while ago, so you're trying to kind of remember those, those reasons. I'm with AJ Bell, and I think fees are definitely the kind of most important thing. They seem to be kind of, I guess it's getting that balance between kind of low fees, but having the choice. I invest in, funds, and I want, a big choice possibly. I have a smaller ISA, stocks and shares ISA, with Trading 212, which is just stocks, because they don't charge commission, which I think makes sense. But yeah, for the kind of the main ISA and my SIP actually as well, I thought that AJBL kind of, had that kind of benefit of being cheap, but also giving you a wide range of investment opportunities.
Absolutely. Ryan, how about you?
Yeah, so I picked mine based on 2 factors you are likely to have covered in your thing, which is one of which is loyalty. Firms that I've previously worked out have been ISA providers. So I had ISAs from when I worked there and haven't closed them down or moved them across out of sense of loyalty. But also a thing of reporting as well. We obviously, as a regulated business have to report any trading that we do. Therefore, I previously had a trading 212 account for the trading, but trying to get contract notes out is a nightmare, and obviously we have to report every trade we do. So because that was very difficult, despite the low fees, I had to close that down because it was just too difficult to report everything. So two factors that went into it were those ones. I probably should say for full clarity now that I have actually emptied my ISA pretty much to try and buy a house, although that's not going anywhere near to plan. Although, to be honest, given I'm not trading it, it's probably actually doing better for my returns sitting in my bank account than being subject to my somewhat patchy trading history.
Yeah, I think the trading 212 thing is quite interesting, actually. It took me a while to kind of figure out how you kind of do that reporting. Fortunately, I have managed to figure out how to do it, but yeah, it's an added step, I guess.
Right.
So it is a very
You might have
small...
learned how to do it as a result of this podcast, which is good. We've also produced similar guides to best trading platforms, best junior ISA providers and best SIP providers. So if you're looking to open a new account, perhaps take a look at those. And on that note, many thanks for joining us for the monthly Roundup, brought to you in association with Schroders. And for more investment trust news, insights and updates, please head over to Kepler Trust Intelligence, and we hope to see you again next month. Past performance is not a reliable indicator of future results. The value of investments can fall as well as rise, and you may get back less than you invested when you decide to sell your investments. It is strongly recommended that if you are a private investor, independent financial advice should be taken before making any investment or financial decision. Please be aware that there can be a time lag when we release podcasts, meaning time-sensitive information may no longer be accurate at the time of publication. Kepler Partners LLP has a relationship with some of the companies covered in this podcast, which may impair its objectivity. Kepler Partners LLP is authorised and regulated by the Financial Conduct Authority.